Now, what's different to the way the professional trader views his trades in the market to the way you view your trades? Let's discuss. But now, as we turn the corner and start a new year, I want to talk to you about a subject that, if you fully understand and appreciate the concept, it will hold you in great stead for 2018 and the subsequent years. This is by far the most important topic that I've covered in all my Forex videos. And I'm also confident in saying that the failure to understand the key principles of what I'm going to explain today is the number one reason why most traders fail in this business. And that's the law of large numbers. Now, before we go into more detail about the law of large numbers, I want to talk to you about probability. So come and join me on the whiteboard and I'll explain further. Okay, so probability. Now, probability is basically the statistical likelihood of an event or events happening at some point in the future. Now, the easiest way to explain probability to you is using the common example of the coin toss. So, for example, if you have an evenly weighted coin with heads and tails as the two possible outcomes, each has a 50-50 chance of happening. So if you were to toss that coin 10 times, the laws of probability state you should get 5 heads and 5 tails. But in reality, you may actually get 6 heads and 4 tails. You may get 7 heads and 3 tails. You may even get 10 heads and 0 tails. Why? Because the sample that you're using here is such a small sample. You're not giving the laws of probability enough time to play out. I'm pretty sure if you toss that same coin 10,000 times, you're going to get pretty close to a 50-50 distribution heads over tails. You may get 51 to 49 or something like that, but it's going to be much closer to what's expected, because now the sample has gone from 10 to a much bigger population of, say, 10,000. You're giving the chance for that probability to play out. So if you put that on a graph, for example, now, it's going to look something like this. So here's the 10 sample. Now, every time you get a head, will go up. Every time you get a tail, you go down. So you get heads, tail, head, 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 tail, 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 head, head, tail. It's going to look something like that. Pretty erratic, not close to the mean of 50-50 at all. If, on the other hand, you toss the coin 10,000 times, it's going to look much more like that. Much more as expected on a 50-50 outcome. Why? Because the sample size is so small here that the outcome is less predictable. On the bigger sample size, the outcome is much more predictable. So why is this relevant in our trading? Well, it's very relevant. Now, presumably you got yourself a strategy that you've back tested. You know what the expectancy is. We know the expectancy on the coin is 50-50. If you got yourself a strategy and you've back tested it, you should know what to expect going forward. So if you understand the laws of probability, you won't be throwing out your strategy just after such a small sample size. You'll be giving it much more time to play out. This forms the very basis of the law of large numbers that we're talking about today. Now, the law of large numbers applies to many different walks of life, not just Forex trading. Now, let me give you an example of something you might be more familiar with, like the insurance market. Now, I'm sure we've all done insurance in the past, be it house insurance or car insurance, or what have you. Let's look at life insurance. So assume you want to get yourself insured. You go to the life insurance company and they're going to ask you for certain information. You might say, I'm 50 years old, I'm a male, non-smoker, and quite a healthy lifestyle. So the insurance company, now they employ a group of people called actuaries. Now the actuary's job is to go back and look at the big population and to come up with a statistical likelihood of where you're likely to live to. So for example, they might come back and say, okay, with all those details, you're likely to live to 86 years old. Okay, and they will price the insurance policy with that in mind. In reality, you may die at 52 years old. You may live to 100 years old. The point being here is the insurance company isn't going to throw out all those past medical history, all that big population that they've been researching over the years just because they got one wrong. In reality, chances are you won't die at 86 years old. This is just a big population likelihood. So the law of large numbers says don't worry about the short term, don't worry about minor fluctuations from what's expected, but keep with it because the law of large numbers says in time, the bigger population will pan out. This is exactly the same as trading. When you're trading, you know what the expectancy is. You're not going to throw out the strategy just because you got a few wrong. Let me explain that again using a chart. Okay, so you've got yourself a strategy. You've back tested your strategy. You know what's expected of that strategy. Remember with the coin toss, you know it's expected to return 50-50. So this strategy, you've run it through your back testing and you're confident that you want to start trading this. You've seen the equity curve in the back test. Now any equity curve or any chart will normally have the time on the horizontal axis and the value on the vertical axis. And your strategy expectancy looks something like this. Think, hey, that's a good strategy. I'm now going to start trading this with my hard-earned dollars. And off the bat, you start trading, and what happens? You start losing money. You think, hang on, this isn't what I was expecting. This has got a positive expectancy. This strategy should deliver me a good return on my investment. In reality, you don't know if this period here is in fact this period here. Or indeed, it could be this period here of the equity curve, or indeed this period here. So you ditch the strategy or you tweak the strategy, you change it because it's had its inevitable losing period. Every strategy will have its losing period. And this is the whole premise behind the law of large numbers. You've got to look at your trading in the big picture, not just about the last trade or the next trade, but the bigger picture. Don't get too stressed about the now moment. Look at the bigger picture. Let the strategy play out. You've done your back testing, you know the expectancy, give faith in that strategy and don't just throw it out or tweak it because of the inevitable losing periods. Okay, so I hope you enjoyed that and indeed found it useful. Do give me a thumbs up if you did, give me a thumbs down if you didn't. I'm big enough and bold enough to accept it. Make sure you subscribe to the channel if you haven't already done so. And don't forget to follow us on Instagram and Facebook so you can keep up to date of what's going on here at forexsignals.com. Until the next time, safe trading, speak to you soon.